Good to see you, Jeremy. So what do you do right here? Are you looking for any kind of stability in yields? And is that what we need to unlock sort of more consistent gains in stocks from here?
Yeah, I'd love for bonds to stop trading like stocks. We historically over longer periods of time don't get that, right? I mean, the 10-year does not often go from 375 to 499 in a very short period of time. So yes, stabilization. I think stabilization is probably your best case scenario for a rally in Q4. I think if we start to see stabilization in rates and what's happening in the earnings picture right now, which is okay, still beating, still coming in, things aren't falling apart. I think you get both of those. I think have a good stage for a rally in Q4. So yes, stabilization to a slight decline in the long-term 10-year rate would be a phenomenal backdrop for stocks, I think.
And Jeremy, are you in that higher for longer camp? Is that what you see in the months, quarters ahead?
Definitely for probably the remainder of the year, we're probably going to be right where we are, right? That's what the Fed's kind of communicated is they're in no particular rush to be cutting. So I don't see a reason for that to do so. Now, again, the massive acceleration in the long end is a little bit of a different story. And the effect of 10 years going up this fast usually doesn't continue up and up and up and higher. Could it happen? Sure, but the call of 7-8% rates, I think, is a bit of a stretch in my imagination. It's possible, and certainly you have to understand that that's possible. But I think it's much more a trend of a stabilization in the long-term rates and a higher for longer, maybe there for a little while. But I think the most likely rate is probably currently where we are to lower. So that's our thought right now with regard to how we're bond positioning as well in the effect of, if we get that, we think there's a certain amount of stocks that'll do well. I think the general markets will do well. And, bond positioning as a result of that, not extending duration too far, but, thinking about some duration in the portfolio.
And sort of more broadly, and I understand that what you're talking about speaks to this question, but how are you thinking about risk right now and what your risk appetite is in this environment?
Yeah, the very nice part about the pain that we've had to take in the bond markets to get here is that you can dial down your risk, still have exposure to the markets overall, but dial down your risk and the penalty isn't as severe as it used to be, right? 2 years ago, if you said I'm going to dial down my risk, I'm basically getting zero return. Now I can say, I'm going to dial down my risk, still get 4 or 5% from a cash holding. There's nothing wrong with having a piece of that there. But what I'm saying is that you don't eschew your stock portfolios that, again, over longer periods of time, 60% of the time over the last 90 years, the stock market has been up over 10%. So, even though you're getting 4 and 5% in cash, don't leave your stocks alone, which can have significant rallies. You want to have a piece of both, and that's absolutely fine.
And Jeremy, in the equity market right now, where do you see opportunity? What are the kinds of companies you're screening for?
Yeah, really what we're looking for right now is the stuff that's getting thrown out a little bit. Really what we're trying to pay attention to is certain thematics, and honestly playing thematics in a couple of different ways, but also just companies that are executing, blocking and tackling that are not being rewarded for this. The early part of this earnings season has been interesting. The effect of the companies that are beating or maintaining and raising guidance are actually slightly down, in the first couple of days afterwards. That's very strange. And for us, that tells us that people are just looking at things within a negative lens right now. But as a result of volatility and those kinds of things, you get opportunities to buy things at a discounted rate. Something like an American Express, which is up today, but was down 5.4% the day after it reported, and it reported that they're maintaining their guidance. So it's very strange in that regard. And so those are the kinds of things that we're looking at and saying, where are these dislocations that we can take advantage of? The other one being, the healthcare component and the effect of basically one or two things is working in healthcare, and that's anything that's associated with GLP-1. So anything outside of that's had a real difficult time. And so within there's some opportunities as well as people have, let those companies go that I still think are going to have opportunities going forward.
Yeah, we do get these sort of manias in markets, right, where people are sort of obsessed with one theme. So outside of GLP-1s, what do you see in healthcare that's interesting to you right now?
Yeah, I think devices. I think devices, the thought that GLP-1s are going to make everyone healthier, they're not going to need procedures anymore. Could it happen? Sure. Is it incredibly long-tailed? I think so. And in the meantime, now you're getting companies like Medtronic and Abbott for very discounted valuations compared to their long-term history, where they, especially Abbott just came out and said they don't see really any influence right now in their Libre numbers, which would probably be the most affected by that. We're actually better than expected. So the companies are telling us things are still fine, things are still operating relatively well. The market is saying, well, this is what's coming down the road. We don't believe that that's coming down the road anytime soon, and that's why we'd be buyers of these two type of names.
Jeremy, Bryan, thanks so much for stopping by today. Appreciate it.
Thanks for having me.